$1 trillion. Since the property market peaked in May 2022, that amount of house equity has been destroyed in just 12 American communities. Furthermore, Cotality, previously CoreLogic, claims that the bleeding is still ongoing. According to a recent survey from Intercontinental Exchange Mortgage Technology, the number of underwater mortgages in our nation has almost doubled in just a single year. According to Adam, in less than 2 years, the percentage of equity-rich properties has decreased from 49% to 44%. Depending on the location they reside in, the average homeowner in the 12 metro areas we're touring today has lost between $50,000 and $275,000 in equity. 3 things to be aware of. First off, the top-ranked city isn't in Texas or Florida, nor is it where the majority of analysts have been pointing. The second is the metro area in Texas, where the present downer has already surpassed the losses incurred during the entire 2008 meltdown by almost 3 times. Thirdly, 27% of all mortgages written in the past 2 years are now underwater in the Florida market. The Federal Reserve Bank of St. Louis just reported total household real estate hit $52 trillion in Q4 2025, with owners' equity sitting at $34 trillion. Read those numbers and you'd think everything is fine. It's not. What's happening is what Cotality economists call a K-shaped market. In the Midwest and Northeast, prices are drifting up, but in Florida, Texas, California, Arizona, Colorado, and the Mountain West, homeowners are watching real money disappear from their balance sheets. The national underwater mortgage rate is 2.1%, the highest since early 2018. That sounds bad until you look at the metro data. In Lakeland, Florida, that number is 10.8%. Cape Coral, 10.1%. Austin, 9.2%. San Antonio, 8.8%. The national average is masking a regional catastrophe. If you bought in 2022, 2023, or 2024 in one of these metros, your equity isn't theoretical. It's already gone. Number 12, New Orleans, Louisiana. Typical equity loss, $45,000 to $55,000, down 19%. What makes New Orleans different from every other city on this list is that the driver isn't oversupply, it's insurance. The average annual home insurance premium in Louisiana now exceeds $11,000. Insurify projects another 27% increase this year. Louisiana ranks first in America for seriously underwater mortgages at 10.7%. The New Orleans Realtors Association reported 18% of pending sales were canceled, not because of price, not because of inspection, but because buyers couldn't get insured. When insurance breaks, equity follows. Number 11, Phoenix, Arizona. Typical equity loss, roughly $50,000, down 10% from peak. In the 2008 crash, Phoenix lost roughly 50% peak to trough. This time, 10%. Either Phoenix is just getting started, or this is what the modern correction looks like in a market that learned from 2008 tighter lending, slower bleed. Number 10, Denver, Colorado. Typical equity loss, $55,000 to $70,000. Cotality reported in February that Denver led the entire country in year-over-year price declines on the S&P Case-Shiller Index, beating Tampa, Seattle, and Phoenix. A Denver homeowner who has owned 12 homes told CBS Colorado, "This is the first time I've ever lost money on a house, ever in my whole life." Number 9, Honolulu, Hawaii. Typical equity loss, $70,000 to $85,000, down 4% from peak. Small percentage, brutal dollar number, because the starting price is so high. Maui wildfire risk, hurricane exposure, and aging condo infrastructure are driving the same insurance spiral seen across Florida. Number 8, Washington, D.C. typical equity loss, $80,000 to $95,000, down 12% from June 2022. Cotality reported that inventory in greater D.C. spiked 60% year over year, the largest single metro inventory surge ever recorded. The driver, federal sector layoffs and the late 2025 government shutdown. Federal workers who bought in 2022 are watching their down payments vanish. Number 7, Naples, Marco Island, Florida. Typical equity loss, $85,000 to $100,000, down 9% year over year. February 2026 was the largest single-month year-over-year drop of any market in the country. Quarterly sales volume is down 18%. HOA fees on a typical condo run $550 a month. And the Surfside Reserve mandates, Florida's law requiring condo associations to fully fund structural reserves, have triggered special assessment of up to $400,000 per unit at older buildings in Aventura and North Miami. That's not a typo. $400,000 in special assessments on a condo someone already owns. Number 6, Cape Coral, Fort Myers, Florida. Typical equity loss, roughly $92,000, down nearly 19% from the July 2022 peak. The Cape Coral Metro has roughly 330,000 owner-occupied housing units. Multiply by $92,000, and that's $30 billion in aggregate equity gone from a single metro since 2022. But single family is only part of the story. The Cape Coral condo market is down 32% from peak, with prices now sitting below October 2005 levels. The typical Cape Coral condo owner is in worse shape today than they were the year before the crash that defined a generation. And that 27% number, 27% of every mortgage originated in Cape Coral in 2023 and 2024 is now underwater. Among FHA loans from those vintages, over a third. Number 5, Northport, Sarasota, Bradenton, Florida. Typical equity loss, $95,000 to $110,000, down 17% from peak, with a year-over-year decline of 7.5%, third worst in the nation. A real example. A single-family home in Venice, Florida, purchased for $565,000 in 2023, sold last December for $455,000. A $110,000 loss. Not a flip, not an investor. A homeowner who absorbed a loss bigger than most Americans' annual income in 3 years. Número 4, Punta Gorda, Florida. Typical equity loss, $130,000 to $140,000, down 25.3% from the July 2022 peak, the largest year-over-year decline in the country at 11.93%. According to Redfin, drawing on First Street Foundation data, 99% of Punta Gorda properties are at risk of severe flooding over the next 30 years. A waterfront home that sold for $985,000 in June 2022 was listed in March 2026 for $899,000 after 6 price cuts. Bank of America's automated valuation model puts its actual value at $721,000, a $264,000 gap between what the owner paid and what the bank thinks it's worth. That's not a market correction. That's climate repricing happening in real time. Number 3, Austin, Round Rock, San Marcos, Texas. The Metro's median sold price has fallen from $550,000 in 2022 to $440,000 in April 2026, a 23.6% decline. Here is a number that should stop every Austin homeowner cold. In an entire 2008 crash, the worst housing collapse since the Great Depression, Austin lost about 8.5% of its home value peak to trough. The current correction is already nearly 3 times that. Austin isn't crashing because of a recession. There's no recession yet. Austin is crashing because Austin priced itself into a fantasy. From 2020 to 2022, home prices spiked 62%, while local incomes grew under 20%. The moment mortgage rates broke past 6%, the fantasy unwound. The Metro has 6.5 months of MLS supply, a decade high. Lender's executive chairman told investors on a recent earnings call that incentives in Florida and Texas are running 14% of the sales price versus a normal range of 4 to 6. Austin will not stabilize until those incentives normalize, which means more downside ahead, probably another 5 to 10%. Number 2, San Francisco, California. Typical equity loss, $150,000 to $170,000, down 11% from a May 2022 peak. The headline city number was actually up 5% year over year in March 2026. That sounds like a recovery. It isn't. It's what analysts call the AI mansion effect, a small group of highly paid AI engineers bidding up scarce trophy homes, pulling the median up while mid-tier homes remain down double digits. If you own a $5 million Pacific Heights mansion, you're fine. If you own a normal home in a normal neighborhood, you've lost real money. Number 1, Oakland, California. Typical equity loss. $265,000 to $275,000, down 25%, the largest dollar equity loss of any major American city in this cycle. The mid-tier home value index just hit its lowest reading since October 2017, meaning Oakland has given back 9 years of appreciation in less than 4 years. One listing flagged by Resi Club in early 2026. A house that first sold for $4.1 million in 2022 just relisted at $2.5 million, a $1.6 million loss on a single property. The drivers are tech employment retrenchment in the East Bay, specifically public safety perception issues, a glut of luxury condos, and Bay Area buyers who would have moved up to Oakland instead, leaving California entirely. A high-price market with weakening demand fundamentals has produced the largest dollar equity losses of any major American city in this cycle, and almost nobody is talking about it. If you bought before 2020, you're still substantially up. Don't panic, but the comps on your street are now being set by people who bought in 2022 and are selling at a loss. Your paper wealth has been reset, whether you sell or not. If you bought in 2022, 2023, or 2024 in Austin, Cape Coral, Punta Gorda, Naples, Sarasota, Oakland, or Denver, your equity is functionally zero or negative. Refinancing is a problem. Selling means bringing cash to closing. The math tells a story. A $400,000 home at 6.3% costs $2,500 a month in principal and interest. The same home at the 3.5% rates buyers were getting in 2021 cost $1,800. That $700 monthly gap is exactly why prices had to fall. If you're a buyer, this is the best negotiating window in 3 years. Builders are paying mortgage buydowns on nearly 3/4 of D.R. Horton closings. Sellers are cutting prices 6 and 7 times before getting an offer. Inventory is at multi-year highs in every metro on this list. If you're a seller who doesn't have to sell, wait, or accept that the price your neighbor got 2 years ago is not the price you'll get this year. What's happening right now is the slowest motion real estate correction in modern American history. Not a crash, not a bubble pop, a slow grinding rebalancing that started in the most overheated markets and is spreading outward one zip code at a time. The data from Cotality, IC Mortgage Technology, Adam, and Zillow all point to a multi-year correction that ends only when prices, incomes, and mortgage rates make sense to each other again. That's where we are, and that's what $1 trillion in evaporated equity actually looks like on the ground.